Well, Sam, thanks again for joining us here today. We're going to talk about commodities. First of all, what's behind the big commodities rally that we're seeing lately?
So, about 2 years ago, we started this very interesting process where commodities have outperformed pretty much all major indices and all other asset classes. One of the key things that happened is the Purchasing Manufacturers Index, which is published by virtually every country and it tracks manufacturing activity, have been in a very, very strong uptrend for the last 18 to 24 months. We've done work that shows a very strong statistical correlation of commodities to this Purchasing Manufacturers Index, also called PMIs. One of the things that's happened recently, and I've heard a lot of objections against commodity investing, is that these PMIs have started to slow down again. And I caution investors not to get trapped in that conversation too far because, yes, they did peak sort of end of last year. They've been coming off a little bit in Q1 of this year. But as of April, we have confirmation that most of them, especially all the developed economies, have resumed an uptrend at very high levels. I encourage investors to think about long-term. This trend is still intact as far as we can see, and we believe it will continue to support commodity prices going forward.
And it's interesting, we look at some of the data, and it looks like commodities are actually at some of the most undervalued level in decades. Can you comment on that?
Yeah, and that's actually something we've been commenting for about a year now. And we have this beautiful chart, and this chart shows the S&P Goldman Sachs Commodities Index divided by the S&P 500 index. So essentially you can think about it as commodities versus brother stocks. And what's happened is this chart is at the lowest ever. It's even lower than when it was 20 years ago during the 1999 dot-com era. At the time, obviously technology was everything. Commodities were in a very dark place after the 1998 Asian crisis, the Russian default, crude prices tanked. And even then, it wasn't as oversold as it is today relative to the overall market, to the broader market. So even if only from a capital allocation perspective, you should roll some of your money into the commodities complex to benefit from this opportunity. We haven't seen this in 20 years. We haven't seen an entry point like this in at least 20 years. So this is a critical point for investors, especially those with long-term investment horizons, to take advantage of it and increase their exposure to commodities.
Let's look at oil and oil field services. Again, we've seen crude oil prices rally, hit 3-year highs over the past few months. The corresponding rally hasn't really been felt in the equities market. Why do you think that is?
I think there's a number of reasons. First and foremost, if we talk specifically about Canada, there's some political issues out west that we're all familiar with. Hopefully, as we've seen in recent weeks, there's been some steps to solve the problem. But crude prices have done very well for a very important reason. The supply-demand imbalance is over. OPEC went through great lengths to chew through the inventory overhang that we had. They've successfully done so. They're committed to continue with a lesser production than they had previously. Conversely, the U.S. is increasing production, but obviously not at the same rate. So I think overall we're in a pretty decent supply-demand balance. Talking about specific sectors and valuations, one of the sectors that I'm most interested in is oil services. Last year in 2017, oil services were the worst performing sector among all commodity sectors that I track. There's about 25 of them. And that's despite crude being up 10 or 15% for the year. Normally, oil services actually give you torque to the upside. Last year, it was the opposite. So there's a disconnect in valuations there. And if you look specifically in North America, what's happening right now, U.S. crude production is growing. Canada is also doing fairly okay. So the oil services companies are starting to increase their activity. That should be fairly beneficial for them. And there's actually a few stock gems that we've identified in the space. The one I like the most is called Hierarchy. They're an oil services company. They operate in Canada. They operate in the U.S. They also operate in Papua New Guinea in the LNG space with contracts with super major companies. So it has a very interesting backstop. But it trades at 3 times enterprise value to EBITDA. That's significantly below their peers. They have double-digit free cash flow yield. They pay a very nice dividend, and they're going to continue growing. So this is a very interesting opportunity for your investors.
So finally, let's talk about precious metals. We look at the gold to silver ratio. Looks like it's favoring silver right now. So what are your thoughts there? Is it a good time to buy silver? Where does that leave gold?
if you know us, we advocate for gold long term. Obviously, we think it's a great diversification tool. Right now, we're getting inflation surprises in most of the developed economies: Japan, the U.S., Europe. Inflation is generally good for gold. It's generally good for all commodities, actually. But gold specifically benefits and also diversifies your portfolio slightly. So we believe gold prices are going to continue to perform. What's interesting right now, and this is more a tactical opportunity, is the gold-silver ratio has reached an extreme point, close to 80 to 1. Over history, it trades 50, as high as low as 35. Yeah. But regardless, there's the tactical opportunity right now is in silver, because for every move in gold, we may see a greater than one move in silver. In that context, there's one stock specifically that we recommend to our investors, Silver Corp Metals. It's actually a Chinese miner of silver, very well respected in China, great relationships with the government. If you've been following the precious metals space, precious metals never leave China. China is actually just sucking all the precious metals they can get their hands on. So they buy at market prices from this company. Great operators, great management. They also trade at a significant discount to their peers, have double-digit return on capital, and high single-digit free cash flow yield, which in this market environment is actually pretty attractive.
Well, thank you for that, Sam, and thanks again for being here today.
Thank you.